A calm bond market is a market where interest rates and bond prices are relatively stable and do not fluctuate significantly. A calm bond market can indicate that investors are confident about the economic outlook and the monetary policy of central banks. However, a calm bond market can also pose some risks and opportunities for investors. One of the main risks of investing in a calm bond market is interest rate risk. This is the risk that interest rates will rise in the future and reduce the value of existing bonds that pay lower coupons. Interest rate risk is higher for bonds with longer maturities and lower coupons, as they are more sensitive to changes in interest rates. For example, if interest rates rise by 1%, a 10-year bond with a 2% coupon will lose about 8.7% of its value, while a 2-year bond with the same coupon will lose only 1.9%. Another risk of investing in a calm bond market is inflation risk. This is the risk that inflation will erode the purchasing power of the fixed payments from bonds over time. Inflation risk is higher for bonds with lower coupons and longer maturities, as they have less protection against rising prices. For example, if inflation is 3%, a bond with a 2% coupon will have a negative real return of -1%, meaning that the investor will lose money in real terms. A third risk of investing in a calm bond market is default risk. This is the risk that the issuer of the bond will fail to pay the principal or interest on time or at all. Default risk is higher for bonds with lower credit ratings and longer maturities, as they reflect a higher probability of default and a longer exposure to default risk. For example, if a bond issuer goes bankrupt, the bondholders may lose part or all of their investment. On the other hand, a calm bond market can also offer some opportunities for investors who are looking for steady income and diversification. Bonds can provide a regular stream of income that can help investors meet their cash flow needs and supplement their other sources of income. Bonds can also diversify a portfolio by reducing its overall volatility and correlation with other assets, such as stocks. Bonds can also benefit from capital appreciation if interest rates fall or credit quality improves. Therefore, investing in a calm bond market requires careful analysis and selection of bonds that match the investor's objectives, risk tolerance, and time horizon. Investors should consider factors such as maturity, coupon, credit rating, callability, tax status, and liquidity when choosing bonds. Investors should also monitor the changes in interest rates, inflation, and credit conditions that may affect the performance of their bond portfolio.